using mortgage interest as an itemized deduction. What is mortgage interest? It is any interest you pay on a secured loan when you bought your first or second home. The loans include the mortgage to buy your home, a second mortgage, a line of credit or a home equity loan. The loan must be secured debt or it will be considered a personal loan and the interest is not deductible. For the average consumer who has managed to acquire credit card debt, car loans, and various other small debts, is the mortgage interest, especially with an interest-only loan, an answer to mortgage interest deductions and the elimination of non-deductible interest. What options does the average consumer have in accommodating the tax need in relation to the housing need? The mortgage interest deductible on the interest-only loan option, once thought to have gone the way of the SL automobile, is back today in the news by the masses. The mortgage market has seen an unbelievable increase in the interest-only loans from just a mere sliver of the market a few years ago, to around 25% of the market share today. That's huge growth, especially when you talk less than 5 years to experience that growth. What benefit does the mortgage interest bring to the table, and does this benefit the homeowner as a taxpayer? This is one question the mortgage lender probably won't be able to answer for you, and one you probably won't think to ask. Who gets the deduction? You do, if you're the primary borrower, legally obligated to pay the debt and actually make the payments. If you are married and both of you signed the loan, then both of you are the primary borrowers. The interest-only loan and the amount of interest you can deduct on your income tax return are one and the same if your income levels are low enough. The concern for the average consumer is the total dollar value they get to take off their tax return. Quite often, the deductions for the consumer aren't enough to contribute to the bottom line, because the income level the percentage of deductible interest is calculated on is simply too high. Your tax deduction is limited if all mortgages on your home are either more than the fair market value of your home or more than $1 million. The greater deduction would be the only advantage to the interest-only loan as far as the taxpayer is concerned, unless, of course, they use the money saved from the interest-only loan to fund a 401k, an IRA, or an MSA. The mortgage interest, and especially the interest-only loan, is sold to the consumer as a way to afford more house, pay off credit card debt, or provide a means to fund a savings of some kind, and if that's true, it can be used for the purpose. And if you're considering paying off those high-interest credit cards, the mortgage interest you're charged on the interest-only loan is fully tax deductible, while the credit cards are not. A word of caution, however, make sure you don't turn around and use those credit cards again, putting yourself right back where you started from, just with a bigger interest payment and less house equity. Why has the market experienced such growth? It's not totally related to the income tax benefit. The home mortgages of today satisfy a common desire for the consumer: instant gratification of bigger and better. Such is the case when it's time to make those needed repairs or house expansion. Remember that your home mortgage must be a secured loan from your main home or second home. No deduction can be made for a mortgage from a third home, fourth home, and so on. The mortgage and the resulting interest are great tools when used by the right people in the right situation. For the average consumer and long-term homeowner, unless you think a better deduction on your tax return is worth the forfeiture of equity in your home, you'd better think twice before refinancing with a second mortgage that generates more interest, but less equity.